In this video, we will discuss the latest moves from Dev Kanteseria from Valley Forge Capital Management. I'm here on Dataroma, and we have the report from Q4 2024, meaning the end of 2024. So you will see what they have bought, what they have sold. You have two new positions. And this will be very interesting. This is one of the best portfolios I think they are on Dataroma. So quality companies, compounding engines for the long term with a competitive advantage that will compound your wealth in the long term. This is exactly the goal of this portfolio. No value plays. We are talking about compounding in great companies. In case this is your first video from this channel, welcome. My name is Christophe Nour. I've been investing in the stock market for almost a decade now, and I have achieved a performance of 25% per year, including with some of these stocks. So I think I will continue to monitor what Dev Kanteseria is doing here because he has great ideas. And let me start this discussion by going to activity, and here you see he has sold one of his position. It was a small position, like 1% of his portfolio. Aspen Technology. So I checked what was Aspen Technology. You see here it's a global leader in asset optimization software, enabling customers within capital-intensive industries to design, operate, and maintain their functions to meet their profitability, safety, and sustainability goals. Okay. This company has some good margins. The company is growing nicely. Look at the revenue growth. I don't know why there is a bug for 2022. And net income has been not following the same trend. So strange stuff happening here. In terms of valuation, you are talking about a forward PE ratio of 35. So not really cheap, not really expensive. And the stock price has been looking nice. And he built the position over the past quarters, and he completely exited this position. That's not a worry, because this was just a starting position. He changed his mind along the way. When did he buy Aspen Technology? He bought Aspen Technology. Let me check. Reduced a little bit here. He bought in 2022. Q1 2022. What was the price in Q1 2022? The price was around here, $150, and now he completely sold out of the position at $260. Okay, so it was AZPN, right? So he bought, and then he reduced by half, and then he bought more, and now he lost. He sold everything. So not a lot of conviction. Frankly speaking, not a lot of conviction for this pick. That's the way he works, right? You start a small position and then you evaluate. Okay, so let me start from the biggest position of his portfolio, Fair Isaac. If my memory is correct, it was not always the largest position of his portfolio. It's just that this stock is going up a lot. And you've seen a lot of momentum for this stock. And for the past few years, the stock has been a triple, a quadruple. It's been a very good investment. The company has a market cap of $40 billion, and that represents 35% of his portfolio. So he trimmed a little bit. This is not the first time he's trimming because of high valuation. He would like, look at this, FICO. Every time, every quarter, he, for the past year, he trimmed a little bit. He trimmed all the quarters. He trimmed. He is still holding a large position in FICO because the company is great, but he does not want to sell. He doesn't want to sell. Just trim a little bit to access to more opportunistic ideas, I would say. If you don't know what Fair Isaac does, it's a great business. They do the FICO score in the US when you get a loan. So it's a software analytics scoring business. They are in a monopoly position in the US, and the score segment has 90% gross margins and is growing very nicely. And in 2018, everything changed for FICO. Since 2018, the company has untapped potential for pricing power. So if you look at the charts, let me show you the financials, right? This is the revenue. You see that in 2018 here, revenue accelerated, revenue growth accelerated. Same thing for the net income here, okay, and then boom, you have an explosion of the net income since 2018 because now the score business is not capped. Before that, the price to have a mortgage score, a FICO score, to have a loan was capped regulatory wise, but then the regulation changed and FICO could have pricing power, so they increased the price of their services by 20% per year, and that's fine. And the business is printing cash. The company has some debt, like $2 billion worth of debt. That's not a lot, especially since the company is delivering $600 million of free cash flow. Look at the free cash flow. Here, up and to the right, and up a lot since 2018. So now the company is doing, let me look at the trailing 12 months. Free cash flow, trailing 12 months is $700 million. And they have what? $2 billion of debt. So in 3 years, they can pay off their debt. Not a worry at all. What do you do with all the cash? They don't acquire businesses. They don't do mergers, acquisitions. They have stopped dividends a couple of years ago. They are doing buybacks. If the stock is trading cheaply, they are doing buybacks. And this is exactly what they have done in 2022 when nobody wanted to touch the stock. Here, when the stock was down and doing nothing for 3-4 years, buybacks, buybacks, buybacks. And then, for some reason, the growth accelerated and the stock is a triple. So a very, very good investment, the smart way. This is not the first time this fund is doing this. And because the stock has tripled, this is now the largest position, 35% of the portfolio. I don't think Dev Kanteseria will sell. I've watched a recent interview from this fund manager. He's saying that FICO has a tremendous pricing power, even now. So they plan to increase the mortgage FICO scores by 100%. Like they can grow revenue by a lot. And we are talking about a business with 80% overall gross margins, nice operating margins. The only worry I have right now is the valuation, right? You have a forward PE ratio of 60. So even though you can double your earnings in 1 or 2 years, that means a future PE ratio of 30. Maybe you have better opportunities at the moment. So this is the reason why he is streaming. If I had to guess, this is the reason. By the way, if you're looking for a complete framework to analyze stocks and build a strong portfolio, I have a coaching program. More on that at the end of the video. Now, the second biggest position is the S&P Global company. He added a little bit, like plus 2%, not a big deal. That's 20% of his portfolio. S&P Global, he invested in this company a few years ago. This is a long-term investor, right? He invested, if my memory is correct, he invested in S&P Global in 2009 during his honeymoon. Maybe you can double check this, but I'm rather sure. In 2009, it was scary to invest in the S&P 500, and he made the right decision. If you don't know what they do, it's a data benchmark analytics company. They operate with big funds. And this is a company that is printing cash with very high margins, 70% gross margin. If you look at the revenue growth, growing every year. Net income, growing every year. Now they have a lot of debt. I don't know why. And you have a free cash flow that is growing nicely over the years. Small buybacks here and there. Seems like in 2022, they did a massive acquisition. I don't know what was... S&P Global 2022 acquisition. Merger with IHS Markit. Okay, very well. S&P Global completes the merger with this one. And this is a company that is quite big. Okay, well, this is not the goal of this video, right? You went here for the updates. He added a little bit. The conviction has not changed. The stock is trading at all-time highs. They delivered the great earnings a few weeks ago. I mean, this is fine. The business is fine. And similarly, he owns MasterCard and Visa. These two companies can compound their revenue earnings by 10%, 12% per year. And they have unlimited runway. They have been doing this for decades. You have a clear duopoly between MasterCard and Visa. He owns both, and these companies have extremely high margins. Look at this: 75% gross margin, net margin of 45%, and the PE ratio is 35. So you are paying a little bit of a premium to buy a duopoly with infinite pricing power. That is a perfect inflation hedge. Good to me. Good to me. Okay, next one is Moody's. Moody's has a similar story with S&P Global. That's 14% of his portfolio. He added 2%, so small, tiny addition. The investment thesis is the same. You invest in more software, more analytics, more complexity in our capitalistic world. They do credit scores, credit ratings on fixed income securities. Similarly to FICO, S&P Global. We are talking about this kind of business that is in the eye of the storm for capitalism, right? So PE ratio of 37, a tiny bit expensive, but the company is fine. Revenue is growing, net income is growing profitably. They have a little bit of debt, but nothing worrisome. This is a company that prints cash every year, small buybacks, small dividend. You can't be wrong on this company. If you invest in all his holdings, maybe you will outperform, maybe you will underperform, but what is sure is that you won't go bankrupt. It's not as if he invested in smart startups, unprofitable stuff. He invests in massively profitable companies with the best margins, best-in-class companies, monopolies, duopolies. You can't be wrong on this one. Warren Buffett made a lot of money out of monopolies, duopolies. So it's a formula that is proven and it's working, and it will continue to work. These companies will improve over time. The next one is Intuit. So it's a software about accounting, right? Intuit, it's a small position in his portfolio. It's Intuit here. It's a 5% holding. He reduced it a little bit by 10%. Okay. And this is a company, small business accounting software. The company is fine. The company, similarly, they have 80% gross margins, so we are talking about a very profitable business. The charts, let me look at the charts. Revenue is going up, net income is going up. They have some debt, but that's not a worry. The free cash flow is going up. Everything is working fine for this business. And the PE ratio is 30. Forward PE ratio of 30. So again, a decent valuation. You pay a little bit of a premium for this business. It's not that expensive, but it's not cheap at all. You pay a little bit of a premium for an excellent business with a lot of pricing power. So that's the reason why he invests in Intuit. He reduced a little bit, he trimmed, but I would not worry about this one. ASML, that could be a surprise, even though you have no change. The surprise is he bought ASML last quarter. Is it last quarter? Or am I completely crazy? Here. Oh no, he doubled down on ASML last quarter. When did he buy ASML? He bought a tiny ASML position in 2023. Okay? He doubled down on ASML, the chip company, last quarter. And now for this quarter, at the end of 2024, he did not buy more. So what is surprising is that the stock price of ASML dropped a little bit, and he didn't take advantage of it. So maybe he is not that confident in ASML. ASML has a monopoly in the EUV lithography chip component. I won't extrapolate on this video. I don't have the time, and you are not here for that reason. But it is a very, very good company in a monopolistic position. Revenue is strong. Earnings are strong. Free cash flows are strong. A lot of cash. Monopoly. You are forced to go through this Dutch company in the chip industry. So definitely it fits the investment style of Valley Forge Capital Management. And they didn't invest more. So maybe the moat is not as powerful as the other companies. What is sure is that MasterCard, Visa, S&P will be here in 10 years, 20 years. I mean, this is very hard to disrupt them. But maybe, I'm guessing at this point, maybe Kanteseria, the portfolio manager, is thinking that the chip industry is moving so fast. Maybe competition will catch up in a couple of years. Not now, not in 3 years, but maybe this industry of chips that is evolving so fast, he's not comfortable. He prefers Visa and MasterCard. It's so hard to disrupt Visa and MasterCard. I've seen some bear cases on the blockchain stuff. I don't buy it at all. So it's very hard to disrupt Visa, MasterCard, Moody's. Moody's was in the eye of the storm in 2009, similarly to S&P Global, and they thrived. They made so much money. So if you are hit by the biggest crisis, the great financial crisis, you are in the eye of the storm, you are accused of fraud, and then you survive and you are more profitable than ever, it shows strength. It shows resilience. So this is what is building conviction for these names. For ASML, I've not seen this kind of phenomenon happening to them. Maybe if the chip industry is hit and ASML is thriving, maybe he will change the position, but no big conviction for ASML for the moment from Valley Forge Capital Management. And you have two new buys, Equifax, MSCI. MSCI, I know the company. It's very similar to S&P Global, Moody's. You are talking about this kind of business that if capitalism is improving, MSCI is improving. They do software analytics. They help fund managers. They create indices. I mean, that's fine. They help big ETFs, and you have a recurring business model with very high margins. Gross margins at 80%. It's a software company after all. Recurring net margin of 40%. The charts are looking beautiful. Look at this. Revenue in blue up and to the right. Net income in green up and to the right. Free cash flow here back down in blue up and to the right. They do small buybacks here and there. They don't have much debt. The debt is $4 billion, but they have a free cash flow generation of $1 billion. So in 4 years, they can pay off all the debt. Not to worry. And the market cap is $40 billion. The stock was expensive in 2021 from a valuation standpoint. PE ratio very high, you can check. And then the valuation came back to reality. And now the business is growing as usual. Business as usual. If you had invested in MSCI for the past 20 years, you would have made 20% per year. So it's a buy and hold. It fits the strategy of Valley Forge Capital, like perfectly. I could imagine MSCI being a bigger holding in the future for Valley Forge Capital. The PE ratio for this one is PE ratio of 33. Yeah, very similar to Moody's, S&P. This is very similar. And then you have another buy, Equifax. To be honest, I don't know this company much. Equifax. Equifax. Is it the good ticker? Equifax. I don't know what they do. Let me check what they do, and that will be the end of this video. Oh, that's a bureau. Okay. Along with Experian and TransUnion, Equifax is one of the leading credit bureaus in the US. Equifax credit report provide credit histories. Yeah, similarly, that's a business that is definitely inside the circle of competence of Dev Kanteseria, the portfolio manager of Valley Forge. I know this business. I did some research on this one when I analyzed FICO a few years ago. So yeah, similarly to Experian, and the other one is TransUnion. These are good businesses. Not as good as S&P, Moody's, MSCI, but fairly good businesses that are still growing, still profitable. Look at this. The revenue is growing. The net income is growing, but not that much. We look at the free cash flow here. Growing, but not that much. Yeah, I prefer the other ones, to be honest. But I'm not the portfolio manager of Valley Forge, so they don't care about my opinion. This is a company with some debt, $5 billion of debt, but free cash flow of $1 billion. So not a debt issue. They do tiny dilutions over the years. Yeah, too bad. They have a small dividend, PE ratio of 32. They have the same valuation as MSCI, but MSCI is growing better. They have better margins. MSCI has a better future, a better position from a competitive standpoint. So I don't know why they invested in Equifax. I mean, it's a winning business, but I prefer the other holdings. So that was it for the portfolio update for Valley Forge Capital. I hope you liked it. If you like this content, I have an investing coaching program. In this program, you will learn a complete investing process. You will learn how to find good stock ideas, how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio. Additionally, you will have access to my personalized guidance for long-term results. We will do weekly calls where we analyze stocks together, and you will have access to my private number available 24/7 for full support. If you are blocked, if you have any questions, I'm here to help. Click the first link in the description to get more information. You will get a video that explains how everything works completely for free. No need to sign up, no need for your email address. Just click the first link in the description and I'll see you on the other side.